This is today's market update. The market closed lower today, and the reason was not one single event. It was a combination of forces hitting at the same time. Investors are now reacting to three major themes. The first is the U.S. labor market. The second is new pressure on AI companies. The third is the growing need for huge amounts of electricity to power the next wave of artificial intelligence. These are not separate stories. They are connected, and together, they are changing how investors think about risk. Let us start with jobs. The latest labor data suggests the U.S. economy is still holding up, but the pace is clearly cooling. Hiring is slowing from earlier levels. Wage pressure is easing in some areas, and the job market is no longer overheating the way it did before. That sounds like good news at first. But for markets, it is more complicated. If the labor market cools too fast, growth could weaken. If it stays too strong, inflation may remain sticky. That puts the Federal Reserve in a difficult position. So investors are stuck in the middle. They want slower inflation, but they do not want a sharp slowdown in the economy. They want rate cuts, but they do not want signs of recession. That tension is one reason markets were nervous today. Now let us move to AI. The big story is not just whether AI is growing. The real question is who controls it and who benefits from it. There are now reports that the Trump administration is asking major US AI companies to submit their most advanced models for government cybersecurity testing. At the same time, there is open discussion about the government taking ownership stakes in leading AI firms. That is a major shift. For years, AI was mostly seen as a private sector growth story. It was about venture capital, public listings, cloud platforms, and software margins. Now it is moving closer to national strategy. That matters because it changes the valuation story. It changes the regulatory story, and it changes the political story. Markets usually do not like uncertainty. They especially do not like uncertainty around ownership, control, and profit sharing. If the government becomes more involved in AI, investors have to think differently about the sector. The market is not just asking which company makes the best model. It is also asking who gets to decide how those models are used, and who gets paid when they succeed. That is a much bigger question than a normal earnings cycle. Now let us turn to the power problem. Artificial intelligence needs a huge amount of electricity. That includes training models, running inference, cooling data centers, and maintaining round-the-clock digital infrastructure. This is where nuclear energy becomes important. A recent milestone in small modular reactors has drawn attention for a reason. It shows that the energy solution for AI is not just about wind, solar, or the existing grid. It is also about stable baseload power. Data centers do not sleep. AI workloads do not wait for cloudy weather or nighttime gaps. They need constant power, and they need it at scale. That is why SMRs have become part of the conversation. They offer a possible path to clean and reliable electricity for the next generation of data infrastructure. Of course, this is not an easy solution. Nuclear projects are expensive. They take time, they face regulation, and they require political support. But the broader message is clear. The AI revolution is not just a software story anymore. It is an energy story too. That has major implications for the stock market. Investors are now looking beyond software names and chip companies. They are also looking at utilities, power equipment, uranium-related stocks, grid, infrastructure, and companies tied to nuclear development. At the same time, some investors are becoming more cautious on high-valuation AI names. They understand the long-term story, but they are asking whether the short-term price already reflects too much optimism. That is a healthy question, because when a theme becomes too crowded, even good news stops being enough. Stocks need stronger earnings. They need better guidance. They need proof that the future growth is actually converting into cash flow. Without that, the market can turn quickly. That is why today's decline should not be viewed as just a random pullback. It is a signal that the market is becoming more selective. A few months ago, investors were happy to buy almost anything linked to AI. Now they want to know who is making money, who is spending too much, and who is exposed to political risk. That is a big difference. The market is also watching inflation very closely. If energy costs rise, inflation may stay elevated for longer. That makes it harder for the Federal Reserve to cut rates aggressively. And if rates stay high, long-duration assets remain under pressure. That includes parts of technology, commercial real estate, and other growth-sensitive sectors. So this is not only about AI. It is about the whole structure of the market. The labor market affects Fed policy. Fed policy affects valuations. AI affects energy demand. Energy demand affects inflation. And inflation affects everything from bond yields to stock multiples. That is why the market is so sensitive right now. There is also a political layer to this story. When the government starts thinking about ownership stakes in AI firms, that sends a message. It says AI is no longer just a commercial opportunity. It is now tied to national security, economic distribution, and political control. That can create support in some areas, but it can also create fear. Some investors may like the idea of state backing. They may see it as a way to reduce risk and accelerate infrastructure. Others will worry about interference, bureaucracy, and reduced freedom for companies to operate. So the reaction will not be uniform, but the risk premium may rise. That is often what happens when a sector becomes strategically important. The reward can be huge, but the rules become less simple. Now let us bring all of this together. Today's market decline was driven by more than just one weak data point or one bad headline. It was the result of a larger reassessment. Investors are asking whether the economy is slowing in a manageable way. They are asking whether AI can keep growing without triggering more regulation. They are asking whether the next wave of AI infrastructure can actually be powered at reasonable cost. And they are asking whether the current market prices already assume too much perfection. That is why the tone changed. The market is not rejecting AI. Not at all. In fact, AI remains one of the most important, long-term growth themes in the world. But the market is becoming more realistic about the path forward. The next phase of AI will likely be more expensive. It will likely be more political. And it will likely depend more heavily on power, data centers, and strategic infrastructure. That means the winners may not be the same as before. It means investors have to think beyond simple momentum. And it means valuation matters again. The market is entering a more mature phase of the AI story. That does not mean the story is over. It means the story is getting harder. And when a story gets harder, investors usually become more selective. That is what we are seeing now. So the main takeaway is simple. The US economy is cooling but not breaking. AI is still powerful, but now it is becoming a national and energy issue. And the stock market is adjusting to that new reality. This is the kind of market where discipline matters more than excitement, where earnings matter more than slogans, and where risk control matters more than chasing the next big theme. Stay informed, stay cautious, and do not assume the AI trade will stay easy forever.